Hey everybody, Bryant back with your second installation of financial literacy training. Today we are focusing on P&L 101. So P&L, just to be incredibly rudimentary, not to pander, but P&L is profit and loss. So focusing on the profit and loss, I will not give you GAAP education, your general accounting practices education. You're not going to be a certified CPA or accountant when you're done with this, but you will have a much deeper and broader understanding of what and how the P&L works. And when you do, you'll also be able to understand how to impact it. And once you can impact it, you'll understand how to control it, how to manage to it, budget to it, and work within the confines of the dollar bills that come in and out of your business. So without further ado, let's go ahead and get started. Let's take a look at a traditional restaurant P&L format. Now, a couple things to note. This is based on the new standard chart of accounts done in conjunction with a handful of amazing restaurateurs, consultants, and the National Restaurant Association. This look right here is the new standard look. And if your P&L doesn't look like this, it's understandable. There's a handful of reasons why this looks the way that it does now versus the way that it's looked before. So let's start by breaking down each one of these sections. Right now, this is a little bit of an eye chart. This is just your summary P&L. But I've got these blue lines to segregate the sections, and I want to jump right in talking about your prime cost. So prime cost is made up of three primary elements: your sales, your cost of sales, and your labor. So if we look at just the top line in sales, you can see this is a populated example. We've got food, liquor, beer, wine, and other operating income. Now, this is a revenue stream that needs to be separated so that we don't artificially inflate or deflate any of these other categories in your profit and loss statement. So what are some examples of some other operating income? They can exist in a bunch of different ways. For example, you might sell retail in your restaurants: hats, shirts, bottled sauces. You might take a cover charge at the door. Maybe you'll have a special event, live music. You're hosting some type of non-traditional restaurant element. That is exactly what goes under other operating income. So those numbers all make quite a bit of sense. Any particular P&L can be more or less expanded in this summary category. For example, you could have beer, wine, liquor, but you could also have draft beer. You'll notice I don't have soft beverages. I have soft beverages built into food. This is traditional. It's a lot easier to manage that way and doesn't traditionally impact the cost. However, if you wanted to pull that out, you're more than welcome to pull that out. Also, under other operating income, if you wanted to have retail as a fixed and an additional category for other operating income, you could do that as well. Another source of other operating income I should talk about, a great example would be gift certificates. Another example, you might have an online store or some type of online retail space in addition to your in-store retail space. You can break that out, or you can look at it at a high level. If you don't sell alcoholic beverages in your establishment, you can certainly back out beer and wine. In those cases, I will traditionally break down the soft beverage cost because it's going to be a larger percentage of mix to sales, and the diversity is going to be quite a bit more than just fountains, sodas, iced tea, lemonade, etc. But as a standard, this is the basic outline of your sales capture. More is better. We want to be able to look at each independent sales line so we can look over in that far right column. We can see the percentage of sales that line contributes. And that's important because there's going to be some benchmarking standards we're going to look at a little bit later. All right, moving on down to cost of sales. Traditionally, one of the largest mistakes that's made on a lot of P&Ls is the food purchases are divided by the entire sales, which will give you an absolutely deflated or under accurate food cost, we can only divide the food sales by the food purchases, or the food purchases by the food sales, as it were. Next, we've got liquor. We've got bar consumables. This is a non-traditional item in this practice, but it is the new practice. The restaurant or food portion should not be liable for any bar consumables that are purchased and given out for free at the bar. If you have snack mix, if you have popcorn, could be some other type of free giveaway, pretzels, peanuts, whatever it happens to be, that cost needs to be associated to the bar. And you can see that it does make up a relatively substantial percentage of the cost of purchased product against the sales. So it's an important one. We don't want that mixed into food. We want to keep these lines separate and clean. If you don't have them, you can go ahead and take bar consumables out, but this is the concept of measuring and extracting and looking at where the impact is. So why do I want to know my bar consumables are 5% of my mixed sales instead of just having it in food? This will allow you to decide if that ROI is there for you. Now, there are some soft cost pieces that are hard to measure. How can you tell if someone's coming into your restaurant for these consumables or not? If it's something you give, it might be a hard thing to take away. But that's not to say that you may not supplement that item with something else. Maybe the bar snack mix with the nuts are just too expensive. Maybe pretzels would be a less expensive way to go, and maybe you season them with your own special seasoning to make them unique and different, or what have you. Maybe you do popcorn. But at least by extracting the item and looking at the impact, and then being able to measure if that impact has the associated worth or value that you're hoping, you can decide if this is worth continuing, modifying, or eliminating. And that is certainly why it's an important item. Now, there's also the concept on bar consumables that if they're salty and they're dry, they make people drink more. And I would have to believe there is some logic applied to that. Plus, it's always nice to have people eat as they drink in order to absorb alcohol and keep them a little bit more equalized. Next, let's move on into labor. Labor has not traditionally been counted this way, and this is another important reason why we're looking at these broken down more specifically. Management, staff, and employee benefits. Now, we're going to get into the detailed portion so you can see exactly what's underneath each one of these categories so you know how to capture your general ledger expenses and apply them to these specific lines. And I'll stop right there and explain this detailed version. Each one of these categories is a master category. Underneath each one of them are expanded versions. There's more than one thing that goes into employee benefits. So when we look at details, we're going to look at what all of those are. They're relatively easy to capture. This just boils them up and gives us a high-level view at the important bullet point elements. So you can see in this example, this restaurant did $119,950 for the period. Period is a 4-week time frame. And you can see their total cost of sales, $36,445, or 30.4%. So for every dollar that came in the door, 30.4 cents of that dollar had to pay for the cost of goods, the cost of sales. Next, you've got labor at $40,310, or 33.6 cents of every dollar that came in the door had to go to pay for the employment staff. All of these numbers compressed, your total cost of sales and your total cost of labor minus your total sales gives you your prime cost. In that prime cost, that percentage is 64%, just looking at the period, not the year to date. Next, let's take a look at, in between the blue lines, we've got our other controllable expenses. Now, some of this, again, is new language. Sometimes you might have heard this as fixed cost, but oftentimes some people would debate, how is this a controllable expense? I have to have these direct operating expenses. I have to have music and entertainment. I have to have marketing. Yes, all of that is true. But the argument could be made that these are subjective costs, but the big difference between your controllable expenses and your non-controllable expenses are your controlled expense pricing can typically be negotiated, or you can have a more innovative system or a different automated type of system or some type of aggregated type of system. There are ways within each one of these lines, and we can talk about that a little bit more specifically when we get into the detailed version. But within all of those, these are expenses that you do have a relevant amount of control over. As we get to the non-controllable expenses here down towards the bottom, occupancy cost, which is going to be made up primarily of your rent and insurance cost, a handful of other things. These costs are fixed. These costs you can't work down from month to month by turning the lights off more frequently or trying to control them by how much of them you use. This is a fixed cost. It's not going to move. Equipment leases, same thing. Now, historically, these haven't been put in the non-controllable expense categories. Oftentimes, they were put under controllable expenses, but equipment leases are nothing more than a loan. It's just like borrowing money from a bank, so it needs to go to this line. But fortunately, at the end of a lease, you could typically own your equipment, we hope. And if that's the case, then this line ends up going away, making that bottom line a bit more healthy, which is always great. And then, of course, depreciation and amortization. That has always been in this line, but it's an important line to capture, and we'll explain the detail in that as well. Moving on. Let's look at the depth of the total operating income. Now that we've kind of captured all of these elements, you can see an additional line under restaurant operating income. Now we've got corporate overhead, interest expense, and other income or expense. The corporate overhead is an important one, but this one typically only applies to multi-unit concepts. And it only applies to multi-unit concepts where there is a burden attached to the entire group. For example, if you have 3 restaurants and you have a corporate office, and in that corporate office you've got full-time or part-time employees working out of that office, that's an expense that needs to be captured, totaled, and divided and split into the units or just added as a whole as a subtractor that takes away a fractional value based on the number of units that you have. Same thing goes with interest expense and other income and expense. Sometimes there's opportunity to either capture money or spend money out of your place, and I can give you some examples of that as we get into the detailed version. But all in all, this is the rundown and the snapshot and the look of your restaurant P&L format, the summary version. So again, remember, break it into the 3 portions. Prime cost. After prime cost, you have your controllable expenses, then your non-controlled expenses. All right, so let's focus now on some of the detailed dynamic of the P&L. And yes, my friends, the devil is in the details. So now we have a more specific look at the breakdown of the P&L detailed version. Now again, I have a populated example because I want you to be able to see this with real time. Don't confuse this populated example as a benchmark example. Some of these numbers from this client that I have are not where you want to be. Some of them are certainly where you want to be, and some of them are better than probably some people can get. Okay, now I had said earlier you could break down your beer and you could put that in your summary, or you can compress the 2 beers and you can put that in your summary version as one item. But within these beverage categories, you could add more categories as you see fit, and all of that is easy to negotiate and manage in this process. Now, you'll also notice an expansion of other operating income. This happened to be for a different client, but it actually calls out different opportunities than what I had called out. You got banquet room rental, banquet equipment rental, service charges, vending machines. There's a whole host of other operating income, and in subsequent trainings and stuff that I do, this is one of the emerging profit centers that restaurants miss that I encourage people to explore early and often. There are so many opportunities to capture additional revenue streams with your business. So I certainly hope you're giving some thought to that, and you can check out some other videos and trainings and my books, anything you want on bobryant.com to get some more information about how exactly to manage that. But moving forward, this is the detailed explanation of sales. Now we look at the cost of sales in food, in beverage, as our costs, they're also broken down. And in order to do that, we have to do what's called general ledger coding, or GL coding, or GL sequencing on an invoice. And that means that each line item on an invoice is categorized as a group that represents one of these lines. So if your beer order comes in, you either have to have an automated system through your accounting company or through your vendor, or you have to manually write the code that applies to bar consumables, that separates bar draft beer from bottled beer, etc. When those codes are put in, whether you're doing it or your accountant is doing it, that's what gives you these totals as the invoices come in, so that you get a proper reflection by category, so that you can look at the popularity and the impact by category. In this particular example, you can see that draft beer had roughly 1/3 of the sales as the bottled beer did, which represents 14.9 versus 34%. So that's important to know. As we do our profitability element, we want to make sure that the item that's the most profitable, or the category that's most profitable, is the one that we're really pushing, the one that we're trying to capture and romance our customers with, so that they will buy more of it, so that we can make more money. And last, we have wine. So moving on down the line, now we can look at labor. So management labor is built in there. And then there's a staff breakdown by back of the house, front of the house, and then any additional service elements, bartending, or even cooks, that would do outside or inside events, private events. We'd break that down into banquets. After that, administrative, and that gives you your total staff. Now, a question that's often asked is, what about ownership? Well, if ownership works a management function, then they should be built in here under the labor for management. This will tell you if your salary is too inflated, if you can't make the payroll work. But it doesn't say that you should or shouldn't do that. It's okay to do it as long as it's accounted for and it's a predictable position. Again, within these elements under staff, you can categorize those however you like. You can be more specific. I certainly wouldn't be less specific, but your environment might ask that you do. You can break it down from back of the house, service staff, and bar staff, so that you can measure the labor spent on the sales generated and look at that as a percentage to identify if you're high or low. I typically wouldn't do that in the beginning, but if I kept noticing that there was a front of the house labor challenge, I might break them down separately and look at them. But I still think that's probably a functionality of some labor matrix worksheets and some analytics you can do off of your time system, whether that's POS or time cards. But either way, you could get as granular as you want. And in my opinion, the more the better, because it gives you a better look on where you're bleeding or leaking and how to stop the leak. Next, looking at employee benefits. That would include payroll taxes, insurance, employee meals. There's a concept. Instead of comping these off and dumping them or putting them as a marketing expense, the best practice says this should be built in under a benefit tactic. And I agree 100%. There's a cost associated. This is a benefit. A lot of restaurants have moved away from this. If you still do this, I strongly suggest that you have an employee meal comp, and those employee meal comp buttons get rang every person who eats, and the number gets built in as an accountability to the employee benefit concept. Now, other. Not a big fan of other. I am also not a big fan of miscellaneous. However, if it represents 0.5 percentage point or less in the overall matrix, then I tend to look the other way. But if it's reoccurring and it's the same thing over and over, and it's a similar number each time, it's pretty darn close to a fixed cost, and it should probably be described or defined. There is a lot of leaking in this type of category. If you're incenting a general manager or a chef and somebody understands that other element and they know how to bury things, that number can grow, it can be undefined, and then it becomes terribly hard to track and hold people accountable to it. So again, you can see the costs, the percentages, the totals. You can see the prime cost. This is just the more detailed version. Now, that's the prime cost detail. And unfortunately, and I apologize, but here comes the eye chart. We need to look at the controllable expenses, and I've broken them down into 3 basic categories. We're going to start with direct operating expense. So let's look at everything that's under that. You might have more of these, you might have less of these. And remember, if you're not lumping them into other or miscellaneous, you're going to be okay. You may or may not have some of these expenses, and there might be some expenses missing. The beauty of this whole system is you can add more and you can take them away. So we got auto and truck expenses. These are company-owned vehicles. Banquet and catering, bar utensils and supplies, cleaning supplies. Yes, that goes here, not in food cost. Contract cleaning, same thing. Equipment and other rentals, flowers and decoration. Freight and fuel surcharges. This is not a food cost. This is a controllable expense. Not everybody charges a freight and fuel surcharge. And not everybody who charges one charges every client a freight and fuel surcharge. I believe in the vendor arena this is negotiable, and you should fight like hell to make sure that you're not getting charged unless you're taking terribly small drops from your vendor and you don't have the leverage to negotiate that. Well, then I don't necessarily have anything I can tell you. But again, it's something you could probably control. Glassware, guest supplies, kitchen utensils and supplies, laundry and dry cleaning, linen rentals. The one that's most interesting to me outside of menu, and I do have a little miscellaneous here, paper and packaging. I definitely believe that paper and packaging belongs in a controllable expense. I like to separate it from food, even if you use it on every food item. I want to know my clean food cost. If you have a to-go packaging system, but you also have an inside dining system, you can't spread that cost across the board on every single thing. I like to make it really clean. If you can eat what you pay for, it goes into my food cost. If you can't, it goes into my controllable expenses. I can change these items without compromising the flavor of what you paid for. I cannot, however, do that in food as readily. Parking, pest control, tableware and serviceware, uniforms. This is all your total direct operating expense. Next, we're going to move on to music and entertainment. Now you can see if you're keeping a nice restaurant segregated P&L, you're probably going to notice new elements in here. If you're not keeping one, then great. You can start, clean slate, but capture all of these pieces. Audio broadcasting service, bands and musicians, that's important. Music licensing fees, oh, the dreaded fee, we all get hit by that. Television broadcast service, it's a good place to put it. Music and entertainment, remember, it's not a utility television broadcasting service. That is a music and entertainment cost. Marketing, again, this category has been expanded as the reach and definition of marketing has changed so much. So advertising, that's one concept. Direct response marketing, public relations and publicity, research, other. Now, again, in that other, there's oftentimes little pieces that come up here and there that are non-reoccurring. But the reason why it's important to break these categories down is because as I look at my spend and I can identify where I spent my money and how it returned for me, I can measure the ROI. If I just have a big lump sum marketing number and a big lump sum trackable number for all my marketing efforts, I can only measure the total ROI. I want to isolate the ROI in each specific category so I know where I should put more money and where I should put less money. Shameless plug, you can read my book Whisper Marketing to get a lot more detail and insight about that concept. But that's the reason why, and this is not my reason, this is the reason why the industry has moved towards breaking these categories out more. Next, you got utilities, your electricity, your gas, heating oil, and other fuel. I'm going to take this a step further. I also put my shortening in this category. Shortening to me is a utility. It's a way to create heat to cook something. You don't put gas into your food cost when you saute something, so why would you put shortening into your food cost when you cook something? It's a cooking medium, not something that you can extract and figure out how much goes into a portion amount on a plate. You're cooking fish and chips or French fries. If you figure out the algorithm that tells you how much oil is absorbed across the board in everything that you fry, then I would be the first person to raise my hand and say, please tell me how to calculate that. In the meantime, and because it is such a hefty cost for a lot of concepts, it's great to put it on its own line. When you put a big expense on its own line, it helps you to measure it month over month or period over period to see the impact and if it's moving up or down. Oftentimes in restaurants, pubs, bar and grill concepts, places that do a lot of frying, to your total purchases, this can represent a double-digit impact in your total purchases from your distributor of food. That's a really big deal. That's an item I'm going to want to see separated. In fact, we can take this up a bit further. Excuse me for that big glaring piece here. Let's go back over to your food sales. Under your cost of food, you can break down your food even more, and you can break that out by meats, you can break that out by poultry, seafood. You can get more specific with that, and a lot of concepts do. I'm a big fan of that if you have an 80-20 rule, and that's 20% of what you buy is representative of 80% of the amount you spend. So all of this can be expanded, and depending on your concept, probably should be expanded. And jumping back forward, sorry for that big confusing swirl. Now let's look at general and administrative expenses. All of these tend to be pretty consistent with what has always been there, but these are new standard lines that have put in. Interesting, consulting and coaching services have been added. Now here are your directors and officers' fees, if you have any. This is a great line for that. Insurance, liability, license and permits, miscellaneous, again, small numbers, so we're not going to freak out too bad on that. Office printing and supports. Beyond that, postage and delivery, professional fees, security and deposit services, state business taxes, training programs and materials, total general admin expenses. Now we move on to repair and maintenance. We've got building and structure, we've got equipment and furniture, grounds and parking lot, and a total for repairs and maintenance. Now, this is the total capture of your controllable expenses. It's your controllable income. Now let's move on to your fixed cost or your non-controllable expenses. Occupancy cost, I said we'd break that down. Here we go. Rent, common area maintenance, otherwise known as CAMs. CAMs are traditionally in some type of share space, some type of share retail space where there's other tenants within the same building or area, shopping mall, complex, what have you. And then you've got other municipal taxes, personal property taxes, real estate taxes, and there's your total occupancy cost. Next, equipment leases, like we talked about, depreciation and amortization pretty much covers it. And then corporate overhead now as we get below the restaurant operating income, corporate overhead, interest, and other expenses. Okay, now likely the reason you're all here. The drum roll, please. It is time for benchmarking. So let's take a look at some prime cost benchmarking. This is where having this P&L already populated will help to illustrate the example of benchmarking. So you can see over on the right in the white boxes you have COS, cost of sales. For a fast casual concept, the median cost of sales, 31.7%. Now let me explain median really quick because I know that this is a concept that gets away from people. If I asked 100 people what their cost of sales were, I would take the bottom 25% and I would get rid of them. I would take the top 25% and I would get rid of them. I would take that 50% in the middle and I would average that, and that is how we establish a median. This is so that we don't skew it one way or the other because sometimes it can get pulled down too far by the bottom or elevated too much by the top. So that is a median. 31.7% cost of sales for fast food, 28.5% cost of sales for quick service concepts, 28.4% for casual full service dining, and 28.9 for fine dining. Now let's look at the cost of labor. Fast food, the median 30.4%. Quick service 29.5%. Casual dining 33.4%, and fine dining 32.6%. So looking at the totals, we see 62.1, 58, 61, and 61.5. Now, if you look at the next box below, in prime cost, now we have them ranked. So 60% is bad. And you might be saying, well, wait a minute. Up in the two categories combined above, we had 62.1. Yes, unfortunately, that's the median. Now, in this last box, where 60% plus, and that's plus a little, that 60% plus represents a bad number. This makes it really hard to be profitable. And unfortunately, the median skews that because there are so many restaurants that aren't profitable. And I believe that the training you're getting today, the education, is one element to help you change that impact. Looking at fast food, 56% is medium profitability, and 52 to 54% combined is good or great profitability on the backside if you can run prime numbers in that area. So these are a little bit depressing, right? Quick service. If you're running 60% combined total, that is bad. 57, you're doing okay. 52 to 54, you're great. Casual dining, 65% total labor and cost of goods, not so good. 57% labor and cost of goods combined. Not too bad, you're making some money. And 52 to 54%, you are doing great. And so on and so forth, 65, 62, 56 to 57, and then 65, 63 for fine dining. 56 to 57 is great or good, at least profitable, and you should be happy. Now, that's the prime cost benchmarking numbers for that category. Let's move on to some other categories. And I will say, I'm going to back this up. I will say that in my opinion, just about any concept that can get to 60, you can still make money. I call it bad because you are not making a ton of money. You are below the average profitability. The median would represent closer to the average profitability. The good would represent beyond the average profitability. And we're also going to benchmark the profitability line so you can see that. But this represents the majority of your spend. Focusing on this is what most people do, and you may or may not do it the right way. That conversation will come in a different video. Let's move on to our controlled cost benchmarking. So you can see direct operating expense. In the particular illustration I have up here, I've got 5.2 for this particular period, 5.7 for the year to date. The median, 4.5 to 5%. Music and entertainment, half a percentage point. So half of a penny on every dollar that comes in should go towards music and entertainment. 1.2 to 2 cents on every dollar that comes in should go to marketing as a median. 2.5 to 3 for utilities, 3 to 4 for general and administrative expense, and 0.5 to 1 penny per dollar that comes in for repair and maintenance. So of that total, I want you to look at the total other controllable expense. It says 16.9. Now you've got controllable income says 19.7. When you take, in this particular example with this client, I want to show this because I've had this question asked a lot. You can see the prime cost was 63.4%. If you add 63.4 to our 16.9 right here, the remainder of the 100 is 19.7. So I don't really have that lined out and colored in there, so I just wanted to be able to explain what the heck that gap was and why it was there. Next, the non-controllable expenses. Occupancy cost, 8.5%. On this particular example, 8.8%. The median, 6 to 7. That's aggressive, and that is definitely pulled down depending on what part of the world you're in. If you are in a high traffic, high density market, that's also being weighed against the median. The guy on the other side who's in a terrible location that is probably paying 3 to 4%. You might be at 8 to 9%. As a general rule, though, I would never take possession of a space at greater than 8% of my sales. If your rent is not 8% of your sales or lower, then you need to raise your sales through as many efforts and impacts as you can, because that rent amount is likely not going to change. During this economic downturn, there was a lot of people that were poised well in this category, and as their sales tanked, their rent didn't change. There was some landlords that did negotiate because they understood the impact of keeping great tenants around, but that didn't happen for everybody. So time to reevaluate, time to make sure you're looking at good numbers, good healthy sales numbers. If you're forecasting, this is a really, really good tool if you're trying to figure out what should my rent be. There are some formulas and stuff that I could give you later, but if you could forecast what your sales would be in a concept, you should be able to take 6% of those forecasted annual sales, and that would help you determine your rent as you grow to your next space. Equipment leases, 0.5 to 1% is the median. Depreciation, amortization, 1.5 to 2% is the median. So the average total for this line, 8 to 10%. And this is always great to see, how do you compare. If you could build your P&L in this exact same way, then you can look at equal data and get good information. And the whole point behind benchmarking, all the way down to the bottom line here, we're looking at gross profit, median gross profit. And this is amongst independent restaurants and corporate restaurants, both. This information comes from a few different sources, different accounting companies, and it's also weighed in with some national information put out by the National Restaurant Association in conjunction with Deloitte that's done every 2 years, called the Restaurant Ops Report. If you wanted to be able to dive a little deeper and go to your specific segment type, you could fish those numbers out. If you are a pizza concept, for example, or a burger concept, or your per person check average was what motivated you to dig deeper. But I would say, as a general rule of thumb, these numbers are pretty good baseline. And again, they're the medians. We want to be much better than the median. We want to be better than average. We want to be on the high side. But hard to get there if you don't know if you're spending too much or too little in the category. If you've never looked at a benchmarking survey before, then how do you know if you're spending the right amount in the category? And if you don't know if you're spending the right amount, or if your amount is way too high, you'd otherwise not know to focus on that and try to fix that. So that's the concept for benchmarking, and really the meat on the bone when it comes to this exercise. First part is get a good, clean, healthy, recognized profit and loss system, P&L formatting system. Once you start capturing your information that way, then you can start looking at medians to see how far good or bad you are against the median. So I hope that's been insightful. Coming up next in part 3, we are going to go to implementation. Now, I see this new standard chart of accounts, this new P&L. How in the heck do I change what I'm doing? How do I implement this? And next, the new standard chart of accounts. How do we code our financials? How do we account for our invoice general ledger codes and what goes where? And last, in part 3, we're going to talk about the advantages over period versus monthly accounting. And this is a subject that, as a food guy by the core, I can't believe I'm saying this, but this is a subject that I am crazy passionate about. If you want to know which way I lean, as a little teaser, it's period. Monthly is terrible. Stay tuned for part 3, and I will tell you why. Anyway, Bo Bryant, thank you very much for tuning in. I know the numbers are mind-numbing, but I appreciate you working on your craft. Look for more information at bobryant.com. As I said earlier, you can check out my books. We've got Whisper Marketing, the cutting-edge source guide for how to impact your marketing and your return on investment. And of course, my other book, On the Menu, where you can learn the science of menu engineering and how to capture the highest profit in the best place on your menu and with your food items. Well, that's it. Until next time, thank you very much. We'll look forward to seeing you in video number 3.